Welcome everyone to this session on buying stocks safely by Mr. Debashis Basu. Mr. Basu is a chartered accountant by qualification with 29 years of experience as a journalist. He has worked with most of India's leading newspapers such as the Times of India, Business World, Financial Express, Business Today, Business India, and has written columns for Business Standard and the Economic Times. May I now invite Mr. Basu to begin the session.
Good afternoon, everybody. This is the first time that we are doing a session which is exclusively devoted to stocks, and you would be wondering why we are doing this as a 170th event and not much earlier, because we felt that we should first discuss a whole lot of personal finance areas, including wills or mutual funds, which are more applicable or more popular with a large number of people. You would have a situation of having to write a will, for instance, under any circumstances. We also believe that that the overall interest in the stock market is lower, much lower today than it was maybe 20 years ago, at a time when UTI was very dominant. We've also believed that the average retail investor would be pretty well served if he takes the mutual fund route, especially since a lot of mutual funds in India have delivered decent results over the last 15 years or so. Having said that, there's nothing more attractive than being able to buy a stock and see it go up 200-300% if you are able to do that successfully. It has certainly been done by a lot of even average people. One of them I know is Sucheta's relative, and I've mentioned about him earlier that over beginning investing life sometime in the 80s, he says that he's actually bought an apartment, got his children educated, and got his daughter married, and has created a retirement nest egg all through stock market investing. Now that's an exceptional kind of record. He's a very average person, and he's got a very, very commonsensical way of going about it. Unfortunately, and I was telling Sucheta this morning, that 99% of the time, the market's job, 99% of the time, is to make a fool out of 99% of the people. So to be in that kind of category where you're 1% of 1%, and not always that too, you will also be fooled several times by the market, is really quite difficult. We've done a lot of analysis on the stocks for a long time. I've done it personally. I've written a book called Face Value, Creation and Destruction of Shareholder Value, which is an entire history of the market ever since FII started investing, which is in 1993, and it ends around 2003. So it's about 10 years of market history. The book is out of print. We'll sort of come out with a print version sometime in future when I have the time. Then I used to run a stock letter, a newsletter called Kensor's Value Trends, where every fortnight I used to discuss all kinds of corporate development and how they affected stocks. And then finally in Moneylife we have a section. You would notice it is a very small section. It's not an extensive section. We write about one particular company, and we've now started a new approach to portfolio where we put out some long-term picks over there and so on. And since January, if you may have got some recent copies with you, you would notice that since January, our model portfolio has not been more than 40% in stocks, which means we are 60% in cash from January onwards, which is when the Sensex hit 6,100. I believe that an average person can very well invest in stocks safely. The problem is that we are constantly bombarded with all kinds of wrong things. So morning to evening, instead of learning the right things, we are bombarded by the media especially, and through the media by all kinds of experts, by things which are wrong, which are harmful, which we automatically believe to be true because Economic Times has written, CNBC has mentioned it, and this guy is managing 5,000 crores, or he's a foreigner, or whatever, doesn't matter how. We have a natural tendency in finance to look up to experts. We tend to believe that, oh, this guy must be knowing, he's got a PhD in finance maybe, so he surely knows much more than me. So, and he's saying this, so it must be true. And we learn at our cost over a period of time, and if we do keep a record, we laugh at what we actually heard, believed, applied, and we've lost money. But most of us don't keep a record, so we tend to make the similar kinds of mistakes again and again. So I will, with this presumption that we make, all of us, including myself, including the experts, most of the time we tend to make mistakes, and the first job is to unlearn. The first job is to know what is wrong outside. First job is to know how not to make mistakes and get rid of the myths and the false beliefs, as I call it, that we sort of create unconsciously. The way I've structured my presentation in 5 parts. The first part is a little short focus on why we lose money in stocks and how to change that. Second is the many myths which I just mentioned, the myths about stock market. All the things that we hear which are not true, which seem to be true, but they're not actually true. What are the actual facts about the market? What are the core things that we need to know which are actually facts? Among 100 list of things, maybe 95 is false, 5 are true. What is that 5 things? Then developing a process by which we can apply. Very surprisingly, in fact, if you really think at it closely, a lot of successful investors in the US are engineers. This is a very peculiar trend. The reason is that engineers are trained to learn a particular theory which is actually can be applied and can be tested. Think of a civil engineer. He's not going to build a bridge and walk away without knowing whether it can take the load that it is meant to take. All right, these things are tested. So they are process driven. They have a way of coming to the truth by following a certain method and a process. So developing a process of investing carefully is very, very important, and I'll share some ideas. It's a vast subject, it's a very extensive thing, and unfortunately to really go deep into it, you need access to data. You need to be able to sort of access a lot of data, and that data is usually not available to an average person, but still one can still create a very, very safe and robust process of investing. And I'll share with you 3 or 4 approaches that we think has actually worked in the past and probably will work very well in the future. First, why we lose money in stocks. First reason we lose money in stocks is because we do not have the discipline or a process. This is very important. In real life, we know that if we do something, there is a consequence. It can be good or it can be bad, or it can be even neutral, but we know there is a cause and effect. For instance, just to give a simple example, if I knock this, there is a noise. If I knock a second time, there is a noise. No matter how many times I knock this, there is a noise. So there is a cause and effect which is very, very clearly established. Based on this, we can create a process. A carpenter used a process to create this lectern, and he will use the same process again and again to achieve exactly the same results. There's not going to be any variation. He'll be able to create a lectern of more or less a similar shape or size. Unfortunately, most of individual investors, when they look at a stock and when they buy a stock, they do not have an entire process in mind why they have bought it. What is the reason? At what stage he would know that he was wrong? Because you can be right or you can be wrong. Fortunately, in market, everything is black and white, plus or minus, up or down, profit or loss. There is no third option anywhere. All right. And the point is, at some stage, even with all the right things, you would probably know that maybe I was wrong about this, and you need to get out. But even before you know that you are wrong about something, you would have to be able to articulate very, very clearly why did you buy the stock in the first place. There was a very recent study which is quite a fascinating thing. In the US, and in Germany and in India, there are all 2-3 different studies. Investors were asked about why they bought a stock, and in fact 70% of them actually could not remember why they actually bought the stock at all. So not even one line of explanation. So one of the ways to handle this is to actually write down why you bought the stock. You write down very, very honestly. And I looked at it, my friend told me, or I followed the wisdom of the media, as I said, or sometime around 11ish, it's a very comical thing that every day CNBC does. There'll be a call from somebody, let's say a gentleman in Chandigarh, and he'd say that I bought Jindal Steel and Power at maybe 800 rupees, now the price is 400, what should I do? Then they'll get an expert to say, and he'll ask, are you looking at the short term or you are looking at the long term? So this is a comical thing which happens day after day in a large number of stocks. So he'll say, I don't know, I don't mind holding for the long term. 50%, he's already lost 50%, so he has no option but to say that I'll hold it for the long term. As they say in the market, long term is short term gone bad. So he will say that I don't mind holding for the long term. So then he'll come up with an explanation. All that he's asking for in that situation is a confirmation whether I did the right thing or not. When he had bought it, if he knew why he bought it, for what objective, at what point he would know that he was wrong and what action he would take. People say that this entire process, as psychologists say, is a pre-commitment. You have to pre-commit to a certain course of action. If something goes wrong, what will I do? This is how disaster management policies are framed. This is how every process in real life that we see, which are dependent on risks, which are dependent on accidents, which are dependent on disasters, this is how all these pathways are formulated. Our process normally is to ask a broker, what do you think? Kya acha lagta hai? So then, as if he's the expert, he'll tell you something. Now, I have a very fascinating story about a gentleman called Radhakishan Damani. He's one of the richest and the most successful investors in India. You normally won't hear his name. He's like Rakesh, and they are all part of the same gang. I don't know whether it's a good or bad thing, but every time somebody had asked, even friends close to him, or a broker or broker's son or a sub-broker, among his close circles, if they had asked him, राधा कृष्ण जी क्या लगता है मार्केट, इससे तो अच्छा लगता है. So they ask him, क्या लेना चाहिए, जो अच्छा लगे. That would be normally his answer. Now people used to criticize him. Why don't you give a tip? I mean, you are such an expert, you're probably buying Hindustan Lever, say that you buy. But I think it was just the right thing to do, because you should think for yourself and you should arrive at a conclusion by which you will know what to buy, when to sell. Do that homework. You ask me, I'll say, jo acha lage. So what instead of doing that, we depend on the wisdom of the media, the analysts. Now this is something, a new breed of people which have come about in the last 15 years or so. They're usually chartered accountants or CFAs or, very qualified. Their job, they are bright people. First of all, you don't become a stock analyst so easily, and all the more because there's just a handful of them. If there are about 40-50 brokerage houses, each of them employing about 50-60 people, you're only talking about a few thousand people, few hundred people in the entire marketplace. And this is a coveted job. People get well paid to do this. The job of an analyst is to talk to the companies and create a spreadsheet of next 5-10 years earnings. Based on that spreadsheet, they are supposed to tell you whether the stock is, buy, sell, accumulate, hold. They have a variety of code words for this, all of them literally meaning nothing. The reason being, across the board, study after study has pointed out that at any time 90% plus of stocks that analysts analyze are a buy. They're never able to come up with a sell. At the most, they'll say it's a hold. All right. The reason being that their job is to enhance the brokerage business of the broking company. They're really employees of the broking company. The more they're able to come up with buy, there's more people will buy the stock and the brokerage will increase. So there's a clear conflict of interest between what his actual role is and what you expect him to do. You expect him to give a impartial view about the stock. Now, even if he were able to give an impartial view of about the stock, he'll only know about the company and the fundamentals. He will not know of the one and only factor which will determine your profit or loss, which is at the price that you're able to buy. All right, and that is something that is completely beyond their capability, or they're not even supposed to do that. Very often, especially in a bull market, we actively look for tips from friends, relatives who are supposed to know, right? And especially with a clear-cut request. Tell me something that's going to double, or tell me something that's going to go up 50%, all right? And you're asking another person who's similarly lacking in process. So he'll probably heard of something that is going up and he'll probably tell you that, but he is not an expert. He's not an expert in the company, he's not looked at the valuation, he's not looked at the price, nothing. Finally, none of these people are responsible for your profit and loss. You're asking, they're telling you. It's all a very casual kind of a thing. For you, you're putting real money. They are not responsible for your profit and loss. One of the most fascinating things is how many people believe that if you are able to talk to companies, you will be able to get at the truth. Now, this is one of the biggest myths among all the sets of people from whom we ask for information and we seek what to buy. This is one of the most dangerous. The reason is that they would, even if they were honest about the performance of their companies, they have no way of knowing, absolutely no way of knowing where the stock is placed in terms of valuation, what the other people are doing with that stock, which alone will determine the value and the price henceforth. Remember that the price of a stock is a price which is collectively determined on a daily, on a minute basis by millions of people. It has nothing to do with the managing director of the company or his analysis or his understanding of the business. Having said that, let me tell you even how his own analysis can be wrong. We had a long interview for our Pathbreaker series. We had a long interview with Baba Kalyani, and he described this fascinating story of 1997. Ratan Tata, chairman at that time of Telco, had called all ancillary suppliers for a huge meeting in Lucknow. This was 1997. And the economy had just come out of the problems of 94, 95, 96, when interest rates were very high, the growth was very low, and things were looking up. The Asian crisis did not affect us so much as it affected Korea and all of these countries. There was a lot of enthusiasm about India. General elections were around the corner. All of that was fine. In 97, March ending, Telco recorded till then its highest ever commercial vehicle sales. And Mr. Ratan Tata wanted to double that over the next 2.5 years. So, which is why he had called all of them, including Kalyani, including Bharat Forge, which is the single biggest supplier of forging parts to Telco. It may be interest for you to know that commercial vehicle sales figure of March 97 was not surpassed by Telco for another 8 years. 97 was the peak. For the next 8 years, it was in only 2005 that Telco surpassed that 97 figure. Now, here was a chairman of the company saying, commit to me how you're going to supply, how you're going to help me double my sales over the next 2 years, which I can very clearly see. And this is what he saw. So even the company managers themselves don't know what is going to happen 6 months to 9 months to 1 year from now, except in certain cases. I wouldn't say that this is applicable to all the cases, but only through exceptions that we can learn what can go wrong. I would say in many cases, such as in pharmaceuticals or in consumer goods, this is probably not going to happen. Will probably happen more in steel, will happen more in engineering, will happen more in industrial materials and all of this. When Mr. Kumar Mangalam Birla went and bought Novelis of Canada, paying $6 billion. He had no clue that the entire aluminium market is going to crash in the next 3 months, which is exactly what happened in 2008. So, company managers are focused on their business, on their day-to-day business. they're focused on next quarter sales, they're doing a good job, they want to do a better job, all that's absolutely fine. They have no clue about how the external environment is going to change, and especially now in these days of globalization, how the external environment can change so completely as to negate all of their views. Finally, even if we were to avoid all of these influences which are constantly being bombarded, and we seek also, you could still buy a great stock and absolutely at the wrong time, and therefore see your wealth go down by not 5%, 10%, but in some cases you could see the stocks go down by 30, 40, 50, even 60%. Some of the best Indian companies, I'll share a chart with you how frightfully wrong one can be, and see the valuation erode, and there is a way to handle it, and I'll explain that. All this especially happens because we are human beings after all. I had done a session earlier on your money and your mind. It's there, there is a YouTube video on that. You can look that up. I keep repeating that the mistakes that we make are something that every single human being at some time or the other in their lives have made, because it is inherent in us. It is because we have survived as an intelligent species over tens of thousands of years and kept on improving ourselves and enhance the civilization. Therefore, those are the factors, the survival factors are the ones that conspire us to make us lose money in case of stock markets or in case of any financial situation. It's a huge big area called behavioral science or neuroeconomics or whatever, and you can look up my video. But the fact is that every single human being is susceptible to panic, greed, regret, confidence, overconfidence, and all of that, and that compounds our mistakes. All of this can be handled through a particular process. Once you have the process, you have to tune out all of these things. Some people have done a little bit of reading. They're serious about stock investing, maybe read about 5-10 books. They are not susceptible to all of this. They think they have a method, and unfortunately that method sometimes turns out to be wrong, and I'll discuss a few of these. This is a little advanced level. So let's say people feel that I want to buy stocks which are of high dividend, stocks that are cheap, that are reasonably valued. It could be high dividend stocks, it could be low PE stocks. These are among the most common ways in which stocks are selected. A company that is paying high dividend, price is low, dividend payout is high, valuation automatically signals that it is low. Or the PE is low. Anybody who knows about PE would know that relative to earnings, the price is low. So in a sense that, in an apples to apples comparison, you get the same apple at a lower price, you buy the lower price apple, it's better. So that's a low PE stocks. Unfortunately, in both cases, there could be a problem. Low dividend stocks can remain low for a very long time. Low PE stocks can remain low for a very long time, and ultimately the E can fall, which signals people why the PE was low. Samir Arora was not such a great investor, but he has great quotes. Some years ago, he said that the PE of a stock signifies the number of years it will survive, which means if the PE is 2 or 3 or 4, it will probably survive for 2, 3, 4 years. That's why the PE is low. And stocks that are lower than book value. Now, book value is another concept that a lot of people used to go by in 30s and 40s. Book value, price to book value was an important measure. This has now become completely irrelevant. The reason why book value has become irrelevant, because the book itself, which means in this case all the assets of the company, may be inflated. Price to book value of Anil Ambani's companies will be very low. Why? Because the book value is very high, artificially inflated. Or there could be an opposite situation for a software company which doesn't have too much of assets, where the price to book value will be very high because the book value is low. Should you avoid that? No, because for some other reason. So book value has become less important in a knowledge economy, in an economy where brain power is far more important than physical assets like plant and machinery. Stable earnings. a lot of companies have earnings which are stable. Now, until the earnings start growing or accelerating, there's a good example is Hero Motors now. Hero Motors earnings is very stable, but the stock price is not going up. Until the earnings start accelerating once again like it used to, there will be no takers for the stock. The stock will remain flat for a very long time. The market can be completely punishing. It doesn't care at all about companies which are earning high profits. But yes, if Hero now starts doing a buyback, for instance, says that I want to buy if the price is 1800 rupees and it says that I want to buy my stock back at 2500, I think it's undervalued. Companies can do these things. These options were not there earlier. Then of course the stock is going to go up. But other than that, stable earnings with no accelerating growth will not mean that your low risk stocks are going to be rewarded. They are not going to be rewarded. The opposite of this is higher returns. Right? These are all situations where the risk is low, so you go for it. Higher returns have their own problems. Great companies, if they are already priced very high, you buy it at a certain level, then you will have to wait for a long time. I'm not saying it's not a good thing to buy, but just because the stock has run up, there's no hard and fast rule like that. But if you buy a high price stock, then you will have to wait for a long time and have to suffer periods of no appreciation for a very long time, and it can even run to 3-4 years in certain cases. Growth stocks. Growth stocks, everybody is chasing them. Risks are extraordinarily high, and this was a situation of, let's say, the stocks like the software stocks in before the .com, all right, or media stocks around the same time, or let's say steel companies in the 2005-06 period. Everybody wanted to buy those companies because the profits were going up. The materials companies, if they are in a strong demand situation, are the best things to buy. Why? Because all their costs are fixed. Their iron ore and all of that will be procured on a long-term contract basis. If they raise the steel prices by 10 rupees, that 10 rupees into 1 million tons straight goes to the bottom line. There's no other cost involved. That's why some of these companies like cement companies or steel companies, when they are facing strong demand, when they are not able to supply, the stocks will just shoot through the roof. Right? But everybody is chasing them, and you should know when to get off them. Fallen angels, for a long time, a stock, good example is TV18. TV18 was such a hot stock in 2002, 3, 4, about the same time. But unfortunately, the business model is broken. So once a stock has fallen by 30, 40, 50%, you have to go and examine whether something so fundamentally wrong with a stock that it is not a matter of cycle, it's not a matter of temporary valuation, it's that something is broken over there. It's just can't be repaired anymore. The media stocks like TV18 and NDTV are in that kind of a category. Okay. Hidden bargains. Very, very difficult to find in Indian market, and it is entirely cyclical. When the overall market is really low, for instance, with the benefit of hindsight, we can look back sometime in February, March of 2009 when entire market was low. That was the time, if you had bought some stocks which 2-3p, those stocks would have shot up. But after that period, we have not been able to find really hidden bargains like let's say last 3 to 4 years, last 3 years especially, smaller stocks, hidden, nobody knows, doing very well. I think it's a myth. It doesn't work so much in India. A lot of people want to chase momentum. Now this is a completely different game altogether, and a game best played by those who are actually want to trade very actively in the market, which is maybe on a 5-day basis, maybe on a daily basis. This session is not for them, but I have a word of advice for them. I think it is an extremely dangerous game to play, and the reason not because that of the volatility per se. I'll explain to you. The volatility of the stock market is one of the killers for average person to understand. And if you don't understand volatility, please don't understand stocks. And the volatility is worst in case of a short-term market movement. Look at this market just 2 days ago. Everybody was so completely bearish about the market. 2-3 things happened. The Fed, it's a manipulated market technically, internationally. when Bernanke came up with that, what is now known as tapering, which is what that he reduces stimulus, the market started going down. I was tweeting on and off that maybe the idea is just to cool down the speculation in this US stock market. It seems that I was right, because once the S&P 500 or Dow Jones came down by 5-6%, 2-3 of the Federal Reserve governors one by one started saying market has misunderstood, there's not going to be tapering. Just say exactly the opposite few days ago, and there are 17 governors, one by one they are saying there's no tapering. And the last 3-4 days the US market has shot up, Indian market has shot up today thanks to that, as well as the decision the government has taken. Now, for those who want to play the momentum game, there is only one thing to know, where the price is going. And when you know, you are wrong. There's nothing else to know. You bought a stock at 150 rupees with a price objective. Let's say you think you're going to get off at 100, and when it's 170, I'm just giving an example. At 170, you may sell, but it's far more important than to know whether it's 170, 190 or whatever. It's far more important to know and pre-commit. Maybe you should write it down. Maybe you should tell your wife that if it hits 145, I'm going to sell. That is the single thing you need to know if you want to play the trading game or the momentum game. It's far more important to know when to get out than to have any profit or a price objective. The profit anyway is there, it's for you. Nobody's going to take it away from you. But if you lose money, all kinds of mistakes start compounding. What happens? At 145, two things can happen. You had no stop loss. So when it hit 145, your thoughts are, oh, it's temporary. It goes to 138. You have two choices. You can buy more, average. The great trader Paul Tudor Jones, who's been trading very, very successfully for the past 30 years now. In his room, he's got in big letters he's written something down. Losers average losers, meaning only losers, they average their losses. Okay, losers average losers, so that he's never tempted to buy once he's wrong. Okay, so most people don't know that. You start averaging, it can go down even further. Now you are completely clueless about what to do. So the best thing over there is to, in fact, a lot of people, they get so emotional about that kind of a situation. They increase their bet sizes big. The most often people go bust are in these kind of situations. What have they done wrong? They have no pre-commitment. Just write that word down. If you do not know that this is what I am going to do when this happens, if then process is not documented, like you can say that I'm making a big comparison, but in any chemical process plant, any engineer would know if then. It's written down. There are huge fat manuals. People are supposed to follow that blindly. Alright, and there's a reason why, otherwise there's going to be a disaster. So disaster in a chemical plant is exactly the same thing as disaster here. Why? Because once an accident happens, it is non-linear. It is not supposed to move in a linear fashion according to your expectations. Anything can happen, and anything can happen in a short time frame. So if you want to play the momentum game, you forget about valuation, forget about fundamentals, forget about EPS, forget about anything else I said. You should know that I bought it at 150 and I'm willing to get out exactly at this point of time. You only have to focus only on loss. Control your losses, you're going to probably make money. Then people use leverage, because the futures have now come, which is extraordinarily dangerous. I'm not getting into the trading issues because this session is not about traders and what they should be doing. IPOs, another way people lose money. There was a time, I have only one word for it. There was a time when people would make money in IPOs. That time is long gone. And the reason why people could make money was either because the pricing was controlled. There was a controller of capital issues. The prices were depressed. Company makes an issue, the stock goes up, and you make money. We have gone into a system of free pricing long ago. Right? Having gone into free pricing, there was an explosion of public issues, in 94, 95, 96. I remember in sometime in February 95, we used to do a lot of IPO analysis at that time. Every issue we used to analyze, and we had a database which we used to sell. There were 145 issues were opening in 1 month. In 1 week, some 70 issues were opening. All of them were finance companies. So I went, and D.R. Mehta was the SEBI chairman, and I went and told him that you have to stop this nonsense. In the name of IPO, people are going to lose money. But he said, but I have nothing to do with it. It's all free price. People can buy, and it's up to them. They should not buy. But most of us don't know that when a company is coming to make an IPO, you are buying it directly from the company. The price is set by them. It's not a market price. It's not a price that has been discovered by millions of buyers and sellers buying and selling and arrived at price. It's a price that the company has decided, I want 400 rupees for my price. The actual valuation may be 200. If the actual valuation of the company is 600, the company will say, I'll do it later. I'm not going to do an issue now. I'm painting it in a black and white, but usually it is like this. If a company whose share is intrinsically valued at 600 is making an issue at 400, then something is wrong with the company. It's desperate for money. You buy that stock, it's going to go down. If the company knows that it's valued at 600 and making at issue at 400, it will be foolish. It will not do it through lots of these interactions with investment bankers who are out to give it the maximum possible price. It will price the issue at 700 when the intrinsic value is 600. So in either case, you are buying a company which is not good enough for your money, or you are buying a company at an IPO where the price is much higher. We had, before Persistent Systems went public, the MD and CFO had come to our office. We were in a small office at MIME at that time. And we suggested that, if you should price your stock at a little lower than what the right valuation is. As they say, leave something on the table for retail investors. Ultimately, a lot of investing is about emotions also. The company, if it wants a set of loyal shareholders, it can very well say that, okay, I'll price my stock as a little lower so that people, let them make money, let them be with me for a while. After a whole series of back and forth, all kinds of discussion, they just come down for a chat. The CFO asked me, but excuse me, why should I sell it at a lower price? So this is the thinking of the company. After all the explanation that you should leave something for the retail investor, he is asking me, why should I do it? So they don't do it. They will not do it. They don't understand this whole idea. This is precisely why all the IPOs of the last 4-5 years, barring 1 or 2 rare exceptions, including public sector companies, go and check a company like Manganese Iron Ore. People don't talk about it. It's a huge company. Stock price is just down like this, 30, 40, 50%. The second reason to avoid IPO is the overall market climate. When the market is really down, let's say, think of a situation of 2003 or 2, there was no interest in stocks. Maybe if the market goes down another 2,000 points, let's say, 16,000 level, that would be a kind of a situation. What is the incentive of a company to make an IPO? Nothing. They can hold on. It's a running company. They have profits. They have bank borrowings. Sales, profit, everything is fine. So they all time it. They wait, let the market go up. So most of the IPOs, if you would notice, would happen in a bull market. Another reason to avoid IPO, because the price is already run up, market is hot, they come and sell you the stock at the price 15% more than its value. From that level, the price can only go down, it can't go up. At least for 17, 18 months, 2 years, 3 years, and then it starts going up on its team. Those were the reasons why we often lose money. Now, I'll take you through some of the market myths which we are constantly bombarded with or we are constantly exposed to. A lot of people have very strong beliefs about a lot of things, about the economy, about stocks, what to buy, when to buy, and why, and so on and so forth. My advice is all strong beliefs should be very weakly held so that you can abandon it the moment the facts are otherwise. Okay. this kind of general statement you will hear. In the long run, stocks are the best. It's of no value. Effectively, it's of no value, because very often the studies are at a start date and an end date. So you can choose your dates and you can come to any conclusion that you want. Economic Times came up with an article a few months ago, and we wrote about that article and how illiterate that entire article was. It took some 7 years, 8 years or something. Stocks have given nothing. FD is better. Now, first of all, you're relying on Sensex. Nobody buys Sensex. You don't go and buy those 30 stocks in the same proportion. So it's okay for illustration purposes to get a general sense of what happens in the marketplace, but for practical purpose, for actual use in real life, a sort of return point to point, starting any time and ending any time according to your wish, and calculating a return has no meaning. So stocks, in the long run, the stocks are best, is that kind of a statement. This I've already covered. Fund managers and analysts know. Now, fund managers I have not covered. Now, you see, the fundamental problem with the stock market, investing in the stock market, is that it's your money. And this is really basic to understanding where you stand and what you need to do. It's your money, right? You bought 1, 5, 10 stocks or whatever you got. Your profit and loss is entirely dependent on that and nothing else. You got nothing to do with X, Y, Z stock or any other view or anything. That is your universe, and you're going to make money or lose money based on that. Now, what is the incentive of a fund manager to be able to give you the right kind of advice or come and say the right kind of things? These are all salaried people, first of all. I am not against salaried people, but stock market is not a place, as I said, black and white, up or down, profit or loss. There is no shades of opinion in this. Either they are right or they are wrong. All right, and their right or wrong has to be completely based on how much involved they are in that business. So if they are not at all involved, if they are a salaried employee, and ultimately if their money comes which has nothing to do with the performance of the fund, all right, they have no, as the Americans say, they have no skin in the game. They are not playing the game with you. They are not out there hurting themselves. Okay, as simple as that. And as you know, fund companies earn money based on a fixed percentage of fee that they charge you. So you put money in a mutual fund, they charge you 1.5%. That is their earning. That is fixed. Your returns are variable. All right. Now, I had this suspicion that they have, as I said, no skin in the game. Some of them are serious. They do a serious job of it. But there is no inherent incentive. There is no penalty. There is no a punishment for them to do a bad job of it. And we know what a terrible job they did in UTI, in 90s, in Canara Bank, in Can Bank Mutual Fund, or BOI, or Alliance, or whatever. I mean, there are lots of examples in domestic and foreign how fund managers have let down their investors. Some time ago, we used to do interviews of fund managers in Moneylife magazine, and we had some series of them. And one of the fund managers said that, well, if money comes into the fund, all we do is put 65% of the money in the stocks which is there in the benchmark. Now, all mutual fund scheme must follow a benchmark against which they are measured. So, say the fund is following Sensex as a benchmark, and suppose in a given month 10 crore new money has come in. They're going to put 65% of that money, or 6.5 crores, in the 30 stocks as a first step. This is his level of accountability. Why? Because he doesn't want his performance to go too much away from the benchmark. He doesn't want to take any risk. Now, you paying him to buy those 30 stocks in that proportion, you can do it all by yourself as well. Illustration, in the meaning of this illustration is that they have no sense of any of these things at a personal level. They don't. For you, it's personal. It's your money. For them, it's just a job. Right? A lot of people will tell you can't time the market, so you have to stay invested. Now, I must admit, timing the market is difficult, but given my long years of experience in watching stocks, I can tell you one thing: unless you have some sense of timing, you are not going to optimize your effort in the marketplace at all. If you think you're just going to buy today and hold, that's going to be a very, very long period until you really start getting results. I have a different way of putting it. Something that goes up and down over a period of time. Something can crash by 40-50%, and that has nothing to do with the company. Okay, you are in a system where you buy Titan and it goes down. A company like Titan goes down by 50% in a year, and you're trying to tell me that timing has nothing to do with it? I'm sorry, I don't agree with that. I think some sense of timing is a must. So this is one of the beliefs that we have imported from America. The reason is very simple, that if you were to time, you would probably go in and out of funds. I'm not saying that's the right thing to do. I'm not saying that you should constantly look at that and find a way to go try to buy high and sell, buy low and sell high. I'm not saying that. What I'm saying is that the Americans have invented this because they want your money in the fund, because they make money on your money. So if you go out, it's a problem for them. And this is why this whole idea has been invented, that you should not time the market. You can't do it. I would say you can do it. And I'll tell you the tools of how to go about doing that. Trend is your best friend. This is of course for the momentum or the short-term traders, and I'm not going too much into it. One of the biggest flaws in the arguments that you're going to hear from the finest minds in the stock market is that the stock market will go up because India's GDP is growing. There is nothing more fallacious than this. This is one of the biggest fallacies in the market, and I'll show you a chart of correlation between GDP and stock prices. Now, forget about that. Which is the country in the world today where GDP is growing at the fastest rate? China. Chinese stock market, Shanghai, is now down on an equivalent Indian terms to at 2009 level, which means if our Sensex were to go down to 9,000, that is where the Chinese stock market is, right? 9,000 or 11,000, that is where the Chinese stock market is. It's the fastest growing nation on the earth. Okay? GDP growth has nothing to do. These are completely two different things, and there's a reason why it's not correlated. One of the countries that grew the fastest before the Chinese came in the 60s was Taiwan. All right, for 10 years or 12 years, the economy was growing at 5%, 7%, 8%. The stock market had not gone anywhere. Same story with India. Every year, India's GDP is plus. It's not negative. 4%, 6%, whatever it is. India's GDP growth is growing every year. And don't forget, this is a post-inflation figure, which means GDP growth is 5% and inflation is 9%. The actual growth in inflation terms is 14%. All right. Even despite this, you will find that for years together, 3 years, 4 years, 5 years, sometimes 7 years, the stock market is completely flat. And during that period, GDP has grown. Right. So even the most people who, they don't say these things to confuse us necessarily, but they believe it. I was just reading some old articles, and some of the finest guys just say this, that GDP growth is there, the stock market has nowhere to go but up. And they have not tested it. The only thing is that they have not gone and seen whether this is correct or not. Inflation versus stock price is just another of those things. Political instability is bad for stocks. You would find this, one of the most common things that people are going to say all the time is that political instability, now the market is not going to do anything. There's no correlation. We have tested all these correlations in the past. It is completely pointless to make this kind of comparisons. Lower interest rates lead to higher stock prices. Everybody for the last 9 months is waiting for with bated breath the day the RBI announces a credit policy. People have just one point agenda. All the foreign institutional investors, the brokers, everybody wants to know if RBI is going to cut rates or not. RBI's rate cutting will have nothing to do with the stock market barring 1 or 2 or 3 days. It will go up, and then the whole effect will go and the stock market will just move on its own. Inflow of foreign money will lead to higher stock prices. Well, I must say the reverse is different, meaning if the foreigners sell, definitely the stock prices will go down. However, we have found a very fascinating correlation. The highest, and this is something that we wrote in Moneylife, the highest amount of FI investment, monthly investment, every time has happened at the market peak. And the maximum amount of outflows have happened at the market bottom. So FIIs are exactly like you and me. They're buying high and selling low. And don't forget, for the money that is coming in, there is equal amount of money that's going out. For every buyer there has to be a seller. Where else will the stock come from, right? So all these are right or wrong in a given context. They are not axiomatic. There's no formula that you have to hold it very, very, very strongly, right? Popular opinion, of course, is dime a dozen. At every stage, any time the market looks very attractive. If they fall, it's attractive. It's going up, then it's attractive because it's going up. All right. Under any circumstances, if you tune into CNBC, you will find all kinds of opinion. The market falls, most people say negatives are all priced in. This is a very interesting point. It is true that most of us, when something is falling, we tend to panic, we tend to get very negative about it, without thinking whether the price is no longer reacting to any further negative news or not, in which case the negatives are priced in. But it's impossible for us to tell this at the time it's happening. We can only tell a few days later. For instance, today a lot of people will come on TV and say the prices were so low, the negatives were all priced in, the market had to go up. And we are able to say this only when we know when the market has gone up. When it was going down, then all new lower targets are offered to us. This I have covered. As I said, GDP growth has nothing to do with any of these things. Growth story is intact. At every stage you will hear people say India growth stories. It's got nothing to do with the stocks that you're going to buy and hold for the long term. Even companies, when there was no growth, there are companies that were either steady or growing. Under any circumstances today, given the penetration that consumer products companies, just to give an example, or banks can still make in this country, whether the GDP grows or not, it has nothing to do with the increasing penetration of finance companies and banks in this country. 70% of this Indian population are not banked properly. So for them, there could be a little blips, there could be little ups and downs. Maybe in some Diwali in the urban area, people would have swiped their credit cards a little more, but the overall trend of the fact that India can, in vast majority of the Indian population, are turning more and more into consumers from abject poverty, and the fact that there are only limited number of people who can supply goods, services and products to them is not going to go away, right? Now, I mentioned this point to you. Sorry, I'm skipping. The reason why GDP and stock markets are not correlated is their stocks do rise, but the economic growth can be reflected in expanding GDP. But think of that situation, 94 to 2003, Indian economy grew every single year. Average GDP growth was 6.8% a year. Shocking, but the Sensex was down by a massive 39% during that 9 years. All right, this is especially true because a lot of things that we learn from abroad, and we just pick it up and we apply. There is no country in the world like America. In what sense? In America, virtually everything is commercial, and anything that is commercial is listed in the stock market. So even a motor training school is listed in UK. All right. So think of a situation where this drivers training school. They have 1,300 branches all across the country, making out 1,000 crore sales every year. It will go and get listed. They want valuation. So this is what has happened in America. There is government. Government is very large and it's become larger now in the last 3-4 years. But commercial activity is huge and all kinds of companies are listed. Not so in India. In India, the government is still a very large component of the economy. Public sector, unlisted, still is a very large component of the economy, and therefore the GDP growth is just not reflected in the stock market. This is a chart that I was telling you about. There is absolutely no correlation between year-to-year GDP growth and Sensex. Okay. Now, having figured out all the things that we need to unlearn or avoid or not listen to or tune out, don't ask for anyone's opinion. This is the first thing that you should be doing. Whether you invest in the market or not, take complete responsibility for your own analysis and your own actions. This is the very first step you need to take. If you're not confident, don't do it. If you're not confident, go back and do a little more work before you decide what to do. When you're asking, remember, we have all kinds of biases as human beings. It applies to all of us. When you are asking for an opinion, we fall for what scientists call confirmation bias. So you bought something and then you go and ask what do you think, or you're committed to buy something and you go and ask what do you think. What you want to know is the other person to tell you, yeah, it's a great thing. That's what you want to hear, essentially. Right? He doesn't know anything about your process. He doesn't know anything of how you arrived at. Finally, he has got nothing to do with your profit and loss. So what is he going to tell you about it? He's not sharing your loss. All right? So first thing to do is not to ask anyone, not even ask me. If you want to ask about a process or about a method, please by all means go and ask, because then you're enhancing your tools. You're enhancing the way you want to look at things, not exactly what to do, because buying and selling is entirely your information. And certainly don't fall for media reports. The reason you should not fall for media reports is because you must understand how the media operates. They have a product to sell. Okay? Every day, the reason for CNBC's existence is to be relevant every minute to you. That is the whole objective. That is a business model. If CNBC came and told you as one stock to buy once in 6 months, they'll have to close down and go. Right? They have to be relevant to you every minute. Have I bought this? What should I do? Sudarshan, what do you think the market will do today? Do you think I should buy this? This is the business model, because they want viewers. If they have viewers, they have advertisers. They don't care a damn about your profit and loss. Same thing with Economic Times. They're selling 4 lakh copies. Samir Jain is calling them and asking, when am I going to hit 5 lakh? What are you doing about it? They have a product to sell. Because they sell 5 lakhs copies, he'll get even more ads. He'll make even more profit. He has a business to run. And the business is nothing other to be exciting on a daily basis for a newspaper, or on a minute-to-minute basis for a television program. If you watch the news programs today, there is just no news in it. It's only screaming match. And the reason is very simple. They think this is a formula that is going to attract people to come and watch. They are not giving you information. They are not giving you well-reasoned analysis. If you keep your Times now next to BBC, as we have done, and you just toggle between the two, you will see the difference between a news organization and a screaming organization, which only is interested in viewership. Right? So that is the business model. To ask them or to look up to them for information and analysis that will enhance your profits is completely ludicrous. It makes no sense to me at all. What you should be doing, as I said, develop a method based on common sense. It can be done. It's very easy to do. Start very small. If you're starting today, long ago I had gone to meet with a friend of mine, Rakesh Junjunwala. This was in 97. And he was already very wealthy and big trader and so on. So one point he kept on repeating. It's not that I went for trading, I just went to chat with him. So he said, if you're investing, please remember, start small. I've never forgotten that. Because a large number of people actually lose money without realizing how much they're risking. So if you have 5 lakhs in the bank to invest in stocks, the crucial thing to know whether in your first purchase to bet 5,000, I'm using the word bet because at that stage it's a gamble. You have a long way to go and you have a lot of things to learn, and you will be battle scarred, you will get hit many times, you will make all kinds of mistakes. It happens to everybody. So if you put 50,000 rupees, you are risking 10%. If you put 1 lakh rupees, you are risking 20%. In an outcome that you have no control over, a process that you have not tested, and given the fact that the market's job is to fool 99% of the people 99% of the time, you are part of that 99 into 99 and most certainly about to lose money. If that is so, in fact, even some accomplished investors and traders, there's a guy called Larry Williams, the brilliant trader. In an open competition, he made $1 million in 1 month. Right? It's documented, and not once but twice. Even somebody like him, when he's actually taking a position, he's not sure what's going to happen. It's only a game of probability. He can, in fact, somebody has said that if you are able, for a trader, it applies to a trader, but should apply to everybody according to me, that even if you are wrong 6 out of 10 times, it's a simple math, 6 out of 10 times, how can you make money? But if you are wrong 6 out of 10 times, which means if you are right 4 times out of 10 times, you can still make money provided you control your losses the time you're wrong, and you're able to make money the other 4 times, which is more than that. The key to that, and let me go back to what Larry Williams said, that every time I take a position, I tell myself this is going to be my biggest loss. Even a person for 30 years he is trading, he's trained his mind to expect a loss. Exactly the opposite of what we do. Our lives is full of hopes. Without hopes, there would be no civilization. In stock market, you have to train yourself to do exactly the reverse. You have to be the most pessimistic person on earth about your actions. I am going to lose money. Tell yourself I'm going to lose money. Then see how much you bet. You will probably bet 5,000 rupees. Let me keep my phone. Look at it exactly the reverse way that normally we do in our normal lives. When we write an exam, a good student wants to come first. He doesn't think I'm going to come last. Right? Because that's what drives life. It's about accomplishment, it's about feeling good about it, it's about confidence, it's about proof, it's about glory. In stock markets, it's exactly the opposite. It's about making sure that you are wrong less number of times and making sure that you lose the least when you're wrong. That's really the crucial thing. And for that, you have to start to really, really small. There's actually a book called I forget the name, but the concept of that book is that the stock market is a game of amateur tennis, not a professional tennis. In professional tennis, the number of winners, the number of winning shots that you make, that determine the winner. In the amateur tennis, the number of losers that you're able to avoid, the fewer the number of your losing shots determines who's the winner. We are all playing amateur tennis when we are betting in the stock market, even the finest, even the best of investors. Okay? Stick to your method. Having developed a process and a method, stick to it against all cost and temptations. There's going to be tremendous amount of influence. As I said, we live in a world of media, of information. You would be surprised to know it's like setting out of your house to go somewhere and somebody tells you, no, not this bus, take that bus and going somewhere else. This is what is happening, will happen in the stock market all the time, because you're living, breathing information. So you have a view. It happens to me. I have a certain view, and I look at that guy on television and starts saying something completely different, and now I've trained my mind. So I look away and I rehearse what I know, and then I said, okay, fine. He's got a view, but it needs training. Otherwise you will realize, if you don't write it down, if you realize that somewhere down the line you've started believing, your mind has changed halfway. It's like you've taken a different bus and gone somewhere else. This happens to most investors all the time.